Hey, what's up, YouTube? Kenny here, and today we're going to talk about market capitulation. So S&P drawing down like it does in a bear market. So we've talked about this dominant trend to the downside. You want to be selling the rips. Anyways, we've been doing pretty well, and right now we're short BITO, which is a Bitcoin derivative ETF, if you will. But I want to talk today about capitulation. So capitulation is essentially that time or that moment where all the panic has flushed out of the market. Everybody has sold, everybody's panic sold, and because all the indicators are aligned, the smart money scoops in behind you and takes you out for a ride. And so that's where you see those big V-shaped recoveries, and it doesn't have to go very far back to see where that was. So S&P 500 during the COVID-19 bounce, very, very sharp V-shaped recovery. And that's what capitulation looks like. Essentially prices you out of the market. You've sold at the bottom. You don't have any more capital to deploy. You're too scared to deploy it, and we bounce really hard to the upside. So funds always track this. Well, the smart ones do. They have a bunch of factors that they put in their panels to look for this. So we have 4 factors here at Redcliffe Research that we look at. And if you're following along, I'm just going to go ahead and tell you what we look at. So very first thing is volume. Is the average volume logarithmically significant on that day or on that week? So what I mean by that is, volume increasing at an exponential level to the point of capitulation. Think of a Richter scale, like an earthquake, right? Richter scale doesn't really move until the earthquake happens. That earthquake has to happen, right? So what has to happen? Price is going down, volume is going up substantially. That's one of the ones that we look at. You can take a look at that on TradingView. It shows average volume per day, and then you can go ahead and figure that out from there. Backtest it yourself, but I'm saying that's one of the ones that you want to look at. So again, price down, volume up. Second one is basically that you want to watch for mutual fund outflows. So mutual funds are important in this game because people who are 70, 80, 90 years old don't have 10 years to recover from a lost decade, right? So these are the folks who need to take money out. And so mutual funds have to concede that, and they have to pull the funds out. So not hedge funds, but mutual funds. Hedge funds can play the game completely different. They're not obliged to have to give the money out. Well, they do, but I mean, there's a whole slew of different things that they can do. They can play around with that, right? But mutual funds have to let those funds come out. So watch the mutual funds, watch them, and see where they're at in terms of positioning. That's one of the ones that you really, really want to watch for. So the other thing you want to watch for is something we watch for every Saturday on the live stream. That is the AAII sentiment indicator, essentially retail sentiment. It's really important for hedge funds to understand what the positioning looks like for retail money. It also means that, again, we've talked about this over and over again, that if the bearish print is so large and so negative, that just means there's a lot of money on the sidelines that can come back into the markets, pushing the markets up very high, very fast. And so just watch for that. That's a sentiment indicator that we watch all the time. And finally, correlation coefficient. And if you don't know what I mean by that is when the S&P sells off 1%, and then RK sells off 1%, and then energy sells off 1%. Those are all different sectors, all different betas, all selling off at the same correlation coefficient. And it's obviously relative to all different types of things, but you can put it in your models. It's quite easy to do. There's tons of charting software that'll help you do that. But my whole point is, there are stocks that trade at like a beta of 3 against the S&P. And if you don't know what that means, it just means that like when the S&P draws down 1%, this stock should move 3%, right? But when everything is moving at the same clip, so basically S&P sells off 5%, they sell off 5%, everybody's just flushing. The money is coming out, in relative scale. That's when you really, really want to watch. And so the final thing is actually cycle work. This is just a bonus, but I'll tell you that, there is an institution of cycles that measures cycles, that looks at things like this, and people do a lot of cycle work that kind of influences how they position, especially in a big kind of macro environment like this, coming off of a crash, coming off of a potential recession. Those are big deals. I don't follow these that closely, but there is correlation. It's mathematically proven that there's correlation. It's not just a random guess. So there's people who use it. So I don't use it, but I do follow people who I know think that, the bottom kind of weans in around July and August. So if you're wondering why people kind of think that way and why I've told you that, hey, July is probably it, it's not so much that I believe it, but if everybody's thinking about it, everybody's talking about it, and everybody's looking for capitulation, and it all lines up, all the stars line up, then hey, Yahtzee, you gotta wait, man. You gotta wait on the sidelines. So again, just a really quick video. Wanted to capture what I think is happening in the markets and sitting on this really uncomfortable ledge trying to talk to you. But anyways, yeah, so a little bit of a fast video, but hopefully it helped you out. Hopefully it brought some clarity to the markets for you. So if you like this kind of thing, you know what to do. We will see you tomorrow. Thanks, everybody. Bye.